morning everybody, my name's Tim Carter, I'm a Client Portfolio Manager on npower's Optimisation Desk, and welcome to this morning's market update on Monday the 20th of April. Last week energy markets had net week-on-week losses in the end, in what was a very much less volatile week compared to recent months. Today there's a bit of support on the prompt contracts, with the key drivers expected to be: number one, line pack is slightly short, encouraged by high exports to the continent. Number two, the lower demand is currently being offset by the continued heavy Norwegian maintenance. Number three, the volatility in the oil and foreign exchange markets is likely to provide a bit more direction this week. So those are the main headlines. If you'd like any more detail, please contact us on the email address provided. Otherwise, please continue to watch for a bit more detail. So firstly, a quick look at the UK gas system in a bit more detail. The line pack forecast at the moment are 6.5 MCM short, so it's a reasonably well balanced supply and demand. Temperature forecasts are following seasonal normal levels through this week, but expected to pick up a little bit towards the weekend, so that's suppressing demand. Spreads to the continent are reasonably healthy, so we've got strong exports to the continent at around 47 MCM. Pipeline flows are adequate, although not amazing, with Teesside receipts higher following disruptions last week. LNG send-out is flat with last week, around 34 MCM send-out at the moment. Meanwhile, storage nominations are fairly quiet, with Holford MRS facility nominating 15 MCM for withdrawal, but Rough is actually injecting around about 1 MCM. Quick look at the power system as well. It's pretty comfortable today, with peak margins around about 13 gigawatts, and that's despite wind feeding outturning below forecast at around 500 megawatts. CCGT is currently the dominant fuel source, with nearly 4 gigawatts more than coal generation, a situation which provides extra demand. It's actually around 34 MCM for gas at the moment, and therefore some support for those prices too. Renewable feed-in is however boosted by up to 4.5 gigawatts of embedded solar generation today. Oil markets were particularly volatile last week, with an underlying trend of bullish support coming from lower than expected inventory builds in the US and some escalating tensions in the Middle East. That comes despite some surge in OPEC production figures. A noticeable build in speculative long positions also helped support those prices last week, with key resistance levels being tested this week. We could see the beginning of a recovery, but if inventory builds recover this week, we could see another mini collapse. It's a quieter week this week in terms of economic data releases, but talks with Greece continue to stumble along, which may dampen the euro recovery. That was supported last week by some really poor US data releases as well. But keep an eye on the UK polling figures this week, as any greater uncertainty created by a potential hung parliament or changing government will damage the strengthening sterling. That's it for this morning. Have a great day, and we'll speak to you again tomorrow.